So we are back again, my students. For today, we'll be looking at our cash flow statement. What an important financial statement that we should understand. In our school, maybe you're running a business, or maybe you just want to know what is going on here. So cash flow statement, one of our three main financial statements in grade 12. So here, for us to understand a cash flow, firstly, here we are dealing with cash, as you can see the word cash flow. We want to know money that is coming in and money that is coming out. So we are only concerned about the real cash. For us to fully understand our cash flow statement, we need to firstly understand the notes. So we have note 1 up until note number 5. When we have mastered all 5 of these notes, rest assured, you and I will be well on our way to acing our exam. Alright, so let us begin with note number 1. The cash generated from operations notes. So because of time, I want to make this not too long video. I just gave you guys the structure here. So for you have to know the structure of the first note. Note number 1 is something like this. We want to know the cash that is generated from operations. It starts like this. This is a structure you can memorize in about 3 minutes. Firstly, we have our net profit before tax. Net profit before tax. Like how we were doing in the income statement on the other video, you will be getting your net profit before tax. So remember the formula, the 100%, the 30%, the 70%. Or maybe you will just be given the net profit before tax in most cases. After getting the net profit before tax, which you will be given in most cases, you insert your net profit before tax. Then you have adjustments in respect of two things. You have your depreciation and your interest expense. Remember, you now have your net profit before tax. After having your net profit before tax, it's either you'll be given a depreciation, you'll add back the depreciation because depreciation is not a cash expense. What is depreciation? Remember, depreciation is the decrease in the value of an asset. So there is no cash that is coming out. It's just that our assets is going down in value. Now, in our net profit before tax, remember income statement, when you have already subtracted the depreciation here, so we need to add it back. So we say net profit before tax plus depreciation plus interest expense, because we'll be showing interest expense on the face of the cash flow. Interest expense, we add it back because it is an important expense that we'll need to show separately. So first, let's start again. We start with our net profit before tax. We add depreciation and we add interest expense. Then we will get, after adding these two, you will get your operating profits before changes in working capital. Net profit before tax plus interest expense plus depreciation will give you operating profit before, remember the word before, which means that after this, there's this coming up. Before changes in working capital. I've labeled this as A. Then we'll have changes in working capital. Basically, changes in working capital are 3 changes. Firstly, we want to know the change in inventory stock. We want to know the change in receivables, the people that owe us. And we want to know change in payables. Payables that are people that we owe money to. After getting all 3 of these changes, the answer it will be put here. Now let's do an example, because just talking about the structure alone is not enough. Let us make an example. In your exam paper, you'll be given 2 years like this, 2023, 2024. Let's start with inventory. I don't have space, so inventory is like, it's gonna be here. I'm just gonna write it here. Inventory. Let's start with inventory. Inventory last year or at the end of last year was, I'm just going to make simple examples like in terms of numbers, but it will be like this in your exam as well. Last year at the end of the year, our inventory was 100,000. At the end of this year, our inventory is 150,000. What happened to our inventory here? Our inventory obviously increased. Yes, that is a good thing because inventory is an asset. But what we are really concerned about here in our cash flow is the movement of cash. If our trading stock or our inventory was 100,000 last year at the end of the year, and at the end of this year it has increased to 150,000, what has made our inventory to increase? Yini you see inventory yethu. Our inventory increased because of what? Because we as a business bought more stock. Is that clear? It increased because we as a business bought more stock. So is that an outflow or an inflow? Did money come in or did money go out? Obviously, we are the ones that bought this inventory, so it's gonna be an outflow of 50,000. 150,000 divided, no more 150,000 minus 100,000, which is 50,000. It's gonna be an outflow which is gonna be shown in brackets because money is coming out. Now, let's say we now have something like this. Inventory at the end of last year was 100,000. But now our inventory is only 10,000 that is left in terms of inventory. What happened to our inventory? Inventory decreased. What is the reason that made our inventory to decrease? Obviously, trading stock or inventory decreases when customers buy. So we had the stocks 100,000 and now it's only 10,000. It has decreased logically because our customers bought more stock. How much stock did they buy? 100,000 minus 10,000, which is 90,000. Remember, they are the ones buying, which means that we are receiving this 90,000. Because it is an inflow, we won't be putting brackets. So if you were given this example or this question, well, now you would have went to your inventory and say 100,000 minus 10,000, which is 90,000, and your 90,000 is here. No bracket. Remember, you don't use the case when it's only me that is allowed to use the case when 90,000 in full. So the 90,000 is an inflow. 90,000 is an inflow. Then moving on to our receivables. Now I said receivables are the people that owe us money, our debtors. These are debtors. Receivables. We are still waiting to receive these amounts. Remember, you have to refer to your balance sheets when it comes to receivables. We did the receivables notes in our balance sheets. But for now, let's say the people that owe us money last year was 100,000. They were owing us 100,000. Now this year, they are owing us only 10,000. What made this to go down? If someone is owing you 100,000 last year, and now that same person or those same people are now owing you 10,000, what is the reason for that? Obviously, you didn't just give them the other 90,000. They paid the 90,000 during the year. So the 90,000 is an inflow. So when receivables decrease from high to low, that is a what? What is that? That is an inflow because it means that they have paid us money. Now let's say instead of 10,000 here, we have 170,000. This is a question in the exam. Last year, your debtors were owing you 100,000. This year, at the end of the year, they're owing you 170,000. What does that mean? It means that you have given them, or you gave them, let's just say, more credits or more money. So these people were owing you 100,000. Let's just make a logical example. When you have people who were owing you 100,000 last year, but these people are now owing you 170,000. What does that mean? That means that you gave them more money, so they are now owing you more. Is that an inflow or an outflow? Yes, there is an outflow because you gave them more credit or more money. So this here is an outflow of how much? 70,000. So when you're going to go to your receivables and say 170,000 minus 100,000, 70,000 in brackets, because this is an outflow of cash. Then we have payables, the people that we owe money to. Now it's our turn to pay. Now it's our turn to pay. Now it's our turn to pay. It's our turn to pay. Payables. Now let's say the people that we were owing money to, we were owing them 100,000 last year. This year we are owing them 170,000. Do you see that the money that we are owing them has increased? Now obviously sometimes that is not a good thing, but we are talking about cash flow. What happened to the cash? Kwenzakaleni ngocash? The reason why this increase is because they offered us, or they gave us more money or more credits. So these people, we were owing them 100,000, now we are owing them 70,000. It means that they gave us another 70,000. That is why we are now owing them 170,000. Is that an inflow or an outflow? Kwenzakaleni ngocash? What happened to cash? We received more cash from them. So that is an inflow. So an increase in payables is equal to inflow. But I don't really want you to memorize it like this. I just want you to know it logically. Just speak about it so that you will understand it better. So let's say now the tables have turned. We were owing these people 100,000 last year. We are now owing them 10,000. What happened here? It means that we went to them and paid them. That is why now we are owing them less than what we were owing them last year. Okay? So they have received more money. But in terms of us, we have taken money out to pay them. So a decrease in payables, a decrease in payables, we have paid them more, so that is an outflow of cash. So when abuzo uthi 100,000 minus 10,000, which is 90,000, that is an outflow. Why? Because we were paying. Now again, after saying net profit before tax plus depreciation plus interest expense, let's just say we had 100,000. Now to get UP, we will need to add. Remember, working capital is these three things. So now this plus this plus this will give us UP. So let's see. No, let's just say here 200,000. So it's gonna be 90,000 minus, because it's in brackets, 70,000. So 90,000 minus 70,000 is equal to 20,000. 20,000 minus 90,000 is gonna be a negative 70,000. So our answer here is gonna be 70,000 in brackets. Now you have your A and you have your B. So you're just gonna say 200,000 minus 70,000 is gonna give us 130,000. That is our cash generated from operations. That is our note number 1. That is it. Then we have note number 2. So make sure that you take this down, pause and go through what I'm saying before you move on to your second note. Take down notes. Ubhale. Alright, so that is it for note number 1. Is my mic still on? Yes, it is still on. After doing the note number 1, we now have our note number 2. So note number 2 here. Note number 2. Our note number 2 is gonna be cash and cash equivalent. Now, in terms of cash and cash equivalent, usually we have bank or savings account if it's positive, and then we have petty cash, and then we have cash float. So remember balance sheets. Let's just say we have 2 years here. We have 2023, 2024 net change. Let's say our bank account last year at the end of the year was 100,000, and this year it is 130,000. What happened to our bank account? Our bank account increased. What does that mean? Did money come in towards the business or did money come out? Obviously, money came in. How much money came in? 30,000 is 130 minus 100,000, which means that this year we put 30,000. That is our net change. But it's not always going to be this simple. Thank God. Otherwise, we wouldn't be having jobs if it was that simple as teachers. Alright, so sometimes our bank, maybe our bank last year at the end of the year was minus 10,000, which means that we had an overdraft. Then this year we have a positive 20,000. What happened here? What was the net change? What movement occurred during the year which led to coming from this ukuze ize ibe la now? What happened? We were owing the bank 10,000. Remember, let's say when you have a bank account, you use it frequently, and now the bank kind of trusts you a little bit. So you have 500 in your bank account, but you see something that is worth 600 and you want to buy it. You use your 500 and then the bank gives you an option of using an extra 100, an extra 100 rands. Then whenever you put the next amount, whenever you deposit any amount to your bank or transfer, the bank will take from that amount. So we use all of our money, then we were given 10,000 by the bank and we also used it. So which means that our balance is not 0, but we are owing 10,000. Now for us, if I transfer you 10,000, the bank will take all of this 10,000. But what happened to this 10,000? And it was money in for you. Because I gave you this 10,000, then the bank took it. But it was money in. Now, your balance is how much? Is 0. You have inserted 10,000, now your balance is 0 after paying the 10,000. Then I give you another 20,000 plus 20,000. What is your new balance? You firstly received 10,000 and that 10,000 was taken by the bank because you were owing them. Then your balance was 0 at that point, at this point. Then I also give you another 20,000. What is your new balance? Your new balance will obviously be that 20,000. And it's because you had 0 after paying this. Then I gave you 20,000. Then your new balance is 20,000 rands. Okay? I don't know. I think that is making sense. But if it's not, questions in the comment section. And I do have a private group where I answer questions privately and offer some sessions privately. So your new balance is 20,000 at the end of the year. But what was your net change? How much did you put in or you received inside your bank or you took out your bank account? You firstly received the 10,000. That is the first net change. Money in was 10,000 and the second money in was 20,000. Meaning our net change was therefore 30,000 because you had a negative. You can't pass ikanje. Remember number line. You have negative numbers this side, then you have 0, then you have positive numbers. Number line in grade R. Crutch. You were this side. You can't go to positive without firstly passing 0. And 0 is in the middle. So it's the same here. You can't have a positive 20,000. You can't go from negative to 20,000 without passing 0. So you firstly paid the 10,000. If you pay, you plus. So it's the plus 10,000 as I was doing here. Then you had a 0 balance. Then you can now have your positive amounts. You only have your 20,000 if you put in 20,000 because remember you had 0 after paying or after receiving this 10,000. Money in 10,000. The second money in was the 20,000, which is the balance, which means that your net change or the money that went in your bank was 30,000 in total. Okay, then you have your petty cash, which are the small amounts in the business premises we use for things that we may need during the course of days. So maybe our petty cash had 150, just making simple numbers. At the beginning of the year, at the end of the year, our petty cash had 350. What does that mean? It means that we put more money into our petty cash. How much? 350 minus 150, which is 200. Or this thing can be 150, no 50. We had 150 at the beginning of the year. At the end, we have 50. It means that we took out money from our petty cash. So that is an outflow of 100 rand. So yeah, the same thing goes for petty cash and cash flows. Okay, but you need to be careful when it comes to your bank. We'll see how we do this when we do the actual cash flow statement. That is our note number 2. Then we have our note number 3, which is dividends paid. Dividends paid is over. It's going to be balance at the beginning. Or number before balance at the beginning, we're going to have dividends as per financial statement. When it comes to dividends, remember dividends are the amounts that we pay to shareholders for investing in the business. We have 2 types of dividends. We have interim which are the dividends that we pay during the year, and we have final dividends, which are the dividends that we declare at the end of the year. So the first line is going to be dividends as per financial statement. This is interim plus final. You get both these dividends, you add them and you put them here. Obviously, we'll be doing questions later on, but for now, it's for you to understand how it is structured. Next line, you'll have your balance at the beginning. Now, we balance at the beginning. Remember, interim dividends are paid. These are the dividends that we pay midway through the year or halfway through the year. The final are not paid at the end of the year, but they are declared, they are only paid at the beginning of the next financial year. So this one here will only be paid next year when the year begins, which means that if last year was 2023, our dividends balance for final dividends will only be paid at the beginning of 2024. So the balance at the beginning here, in other words, will be the final dividends of last year. The balance at the beginning of the year that you are doing will be the same amount as your final dividends from the previous year. Because in the previous year, they did not pay this. They declared it will only be paid here at the beginning of the year. Please take note of that. And Nikama, they call final dividends share. In your information, you will see this word, shareholders for dividends. They are referring to final dividends here. So when you take last year's figure for final dividends, you will put this as your balance at the beginning for this year. Okay, so we will be paying this out. Now, both of these amounts will be in brackets. Then we will have our balance at end. Now, with balance at the end here for this year will be this year's final dividends. Remember, my final dividends, the word is shareholders for dividends. You'll go and check shareholders for dividends of this year. It will be here. Remember, we won't be putting brackets here in this because we will not be paying this during the end of this year, but we will only pay it beginning of the next financial year. So the structure is like this. This will be in brackets. You put your interim and your final together, and it's going to be here. Balance at the beginning is last year's final dividends, which will only be paid beginning of this year in brackets. Balance at the end is the final dividends for this year, but we won't be putting it in brackets because we won't be paying this amount kulo nyaka. Then again, you will say this amount plus this will give you the total that will be here. Let's say this was 100,000, this was 20,000 example, and this one was 30,000. So when it's negative 100,000 plus negative 20 is going to be negative 120. Negative 120 plus positive 30 is going to be negative 90,000. Then you take this amount as it is, then you go and insert it in your cash flow statement. If you are not given this, I prefer you do this note on the side, even during your exam on the side, and you just take the figures and you put them as they are. You will see when we do the actual question. But it gets easier when you understand all of this. Then we have our fourth note. Note number 4. Our note number 4 is the income. I don't have space here, but it's going to be the income tax notes. This one here, you need to be very careful when it comes to it. The corner is going to be similar to this. It's going to be income tax according to financial statement, which is the income tax, according to as per income statement. That is the income tax that you'll find in your income statement. Then you'll have your balance at the beginning, your balance at the end, then income tax paid. Now when it comes to this, it's not the same as dividends. As dividends are structured like this. This is always in brackets, always in brackets, always out of brackets. Now when it comes to this, only this is always in brackets. Only this. This and this, these two, it can be in brackets, maybe not. It depends on the question. That's why we need to be extra careful when it comes to our income tax. I need you to listen very careful when it comes to this, or just about anything. I need you to be careful. 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 Now, income tax, the money that we will pay to SARS. Let's have a question as how you will be given in your exam. Income tax 2023. Okay, maybe this was supposed to be up. Income tax, let's say last year sometimes they can say DR, which is with debits or data, or sometimes they can say credits, but in both these I just said data for the purpose of firstly making you understand. So when they say 10,000 SARS is DR, it means that SARS, remember SARS is the person that we owe money to. If you are in SA, our tax goes to SARS. If you're in another country, I don't know, whatever country, you'll be putting, whoever you guys are paying, okay? So with us, if it says 1,000, let me just add another zero. If it says 10,000 debits, it means that SARS is a debtor. If it says 10,000 CR, it would have meant SARS was a creditor. But let's start with the debtor part. If SARS is a debtor, what does that mean? It means that SARS is owing us as a business money. So when you are given 2 years like this one is beginning, this one is end. So at the beginning of the year, SARS was owing us 10,000. SARS was a debtor. So if SARS is owing us at the beginning of the year, it means that SARS will be paying us during the year. So our balance at the beginning, remember SARS is owing us because SARS is a debtor. If SARS is owing us at the beginning of the year, SARS will be paying us this 10,000. No brackets here because SARS is the one that will be paying us. So we will be receiving money. Then at the end of the year, now remember here, this one here is the one that you get in your income statement, or you'll be given the percentage as how we were doing it in our income statement question. Remember, we have net profit before tax, then we have income tax in our income statement, then we have net profit after tax. This one here is before the tax was taken, so it's always represented by 100%. I'm repeating this again. Income tax, usually it says 30% or sometimes 28% between those two. Sometimes maybe you will be given something different, but usually it's 30% or 28%. So if this one is 100%, this is before the tax is taken, then 30% is taken off the tax, which means that this will be 70%. Then here you will play with your figures again now. If the net profit before tax, for example, was 1 million, you will say 1 million divided by the percentage. The formula is you take the amount you are given. You can be given any of these three. Let's say we are given this. You will say 1 million divided by the percentage it represents. Then multiply by the percentage you are looking for. So let's say when you are looking for 30%, so divided by 100 times 30%, then you will get your answer for here, which will be 300,000. So this is 300,000. Now that you have these two, so 100,000. Oh, this one was 1 million. 1 million minus 300,000 will give you 700,000 for here. So the formula is, because you'll always be given something for this. You can be given this, so you're gonna say the amount you are given divided by 70%, because this one is 70%, times the percentage you are looking for. If you are looking for 30, times it by 30%. We did this. That is why I'm being fast with it. Now let's go back to our balance at the end. If SARS is a debtor at the end of the year, remember a debtor is someone that owes you money. If SARS is a debtor at the end of the year, it means that we overpaid. The only way SARS can owe us money is when we have overpaid during the year. So that now at the end of the year, SARS needs to give us back some of the money or all of the money that we have overpaid. So if SARS is a debtor at the end of the year, it means that SARS or we overpaid SARS during the year by that amount. So if we have overpaid during the year by that amount, what is that? Is that an inflow or an outflow? That is an outflow because we overpaid SARS. So money came out of our pockets. So now we said 100,000. How much money came out? 10,000, which will be in brackets. Then again, 300,000 plus 10,000 minus 10,000 is going to give us 300,000 in brackets. You will take this amount and then you will put it in your cash flow. But I need to do other examples for this because this one here, you need to master it. You need to master it. And you need to understand, you need to talk it. Explain it to someone, even if they do not do accounting. If you will be able to explain this to another person, uzoba right. So now, let's say 15,000. And then 30,000. You are given something like this in your information. So if it's not written debits or credits, we always assume debits. So if it's like this, it means that there is a debit that is invisible here. At the beginning of the year, I'll wrap this off. At the beginning of this year, SARS was a what? A debtor. Which means that SARS was owing us at the beginning of the year, which means that SARS needs to pay us at the beginning of the year. 15,000. That is an inflow. At the end of the year, SARS is a creditor. What does that mean? It means that SARS, we need to pay SARS because we are still owing SARS. If you are still owing someone money, what does that mean? It means that you did not pay during the year. So Natsigela here, we are owing SARS 30,000 at the end of the year. It means that we did not pay this 30,000. Asukokanga this 30,000. We were supposed to pay this. So it was supposed to be in outflow because we were supposed to pay this. but we haven't yet paid. So we cannot say the outflow when we haven't yet paid. So if at the end of the year there's a credit, it means that we are owing SARS, which means that we have not yet paid. If we have not yet paid, that is an inflow because no cash came out of us. And you get this plus this plus this, you'll be getting your answer. Let's repeat. Let's do another example. Let's just say here, there's a credit. What does that mean? It means that we are owing SARS. SARS is a creditor, and a creditor is someone that we owe money to. If SARS is a credit at the beginning of the year, it means that during the year, we are the ones that will be paying this 15,000. So at the beginning of the year, if it's credits, it means that kumeles khokhe, we have to pay. So money will come out of us, 15,000. Then at the end of the year, SARS is still, we are still owing SARS, which means that we did not pay this 30,000 during the year. If we did not pay it, remember, this is the beginning, this is the end. Don't confuse. You must talk. Beginning, SARS was owing us. We were owing SARS. If we are owing SARS at the beginning, we have to pay at the beginning or during the year. So if it's at the beginning, that is an outflow. But if it's at the end, it means that we were supposed to pay SARS during the year, but we haven't yet paid. Hence, the year has ended. So that cannot be an outflow. It's going to be an inflow. Please repeat this as many times as you can, because this thing here can be tricky. Wena okwakho is to repeat it as many times so that you will be able to master it. Then after getting your income tax paid here, you take that amount as it is, you go and put it in your cash flow. Okay. Then now we have our fifth note, which is fixed assets purchased. Note number 5. For note number 5, our fixed asset purchased, I want us to know there's a method called 5 fingers method. Which basically is, remember you're talking about fixed asset here. Our 5 fingers method is going to be carrying value at beginning or last year. It's the same. Beginning and last year is the same. Plus additions minus the depreciation. If there's depreciation, of course there will be depreciation. If you have assets, fixed assets, minus disposals minus carrying value at the end. So this one here, this here, will be helping us to see, okay, maybe before that, the disposals here should be at carrying value, as you do in your note number 3, in your fixed asset notes. This one here, if you happen to be missing, maybe you are looking for additions, fixed assets purchased. In most cases, you'll have all your other information. This is to help you get any missing figure. Maybe you have this, maybe the missing figure is this. You'll also be able to get this using this. So what you do is you put this formula as it is, and you put your amounts. If you are let's say you are looking for additions. That's now we don't have additions. We're just gonna say carrying value at the beginning. We'll put the amount if it's 1 million plus, follow the formula, plus additions. We don't have additions. That is what we are looking for. We're just gonna say plus 0 because we are looking for it. Minus your depreciation. Maybe your depreciation is 100,000 you are given. Then minus your disposals at carrying value, using your information that we taught or we talked about in our fixed assets. minus maybe another 100,000, minus carrying value at the end. Maybe carrying value at the end was 500,000. You putting all of this in the calculator will help you get the missing figure. So it's going to be 1 million plus 0, 1 million. Minus 100,000, 900,000. Minus 100,000, 800,000. Minus 500,000, which will give us 300,000. So the answer that you will be getting here is the missing figure. So our fixed assets purchased, my additions, the fixed asset that we bought was 300,000. Remember, the 5 fingers method will help you get this if you don't have, get this, or any of these 5 if we are not given, if we have the others. 5 fingers method together. Carrying value at the beginning plus additions minus disposals minus depreciation minus carrying value at the end will help us get the missing figure. That is our notes 1 to 5. After knowing or after mastering notes 1 to 5, then your cash flow statement becomes easy, very easy if you have mastered these 5 notes. Now for cash flow statement, I want you to remember for your cash flow statement, I want you to remember OIF. That is what I want you to remember for your cash flow statement. O is for operations or operating activities. Operating activities. We have our operating activities here. Then we'll have our investing activities. Just gonna. Then our F is financing activities. Once you have your OIF, suyazi-ke wena-ke. Operating activities. Remember we did note number 1. Note number 1 was cash generated from operations. The answer that you got for your note number 1, cash generated from operations. Is your note number 1. You take your answer for note number 1 as it is and you'll put it here. It's going to be here. Then, remember, we removed interest expense. Interest paid will be here. It's going to be here. Obviously, it's paid. It's going to be in brackets. That is your structure. Then we will have dividends paid. Remember your notes for dividends, note number 3, you take your final answer as it is, you put it here. So that is why I was saying once you have mastered your notes, things become easy. Then remember we also had income tax paid, our note number 4. Take your final answer, you put it as it is. If you are not required to do the notes separately, all the answers that you had for your income tax paid, they're on the totals. You take them, you put them here. If it was in brackets, you would see minus. If it was a positive, you would see plus. But we'll do it when we do the question, actual question. But it's like that. Then you take 1, 2, 3, 4, and you'll get your operating activities. Then we have our investing activities. So when it comes to investing activities, let's call them investing. Yeah, we don't need all of these lines. Firstly, when we invest, we talk about fixed deposit. Fixed deposits here, so let's make an example. So you won't just say fixed deposits. What's in your change in fixed deposits or financial assets. But I'm using the word fixed for a specific purpose to make it easy for you when we do the next one. Let's say our fixed deposits was 100,000 last year. This year, 150,000. What is a fixed deposit? Remember, fixed deposit is the amount that we took from us. We invested it in a bank. So it came out of us and we gave the bank for them to invest. We are basically investing in the bank. The bank will give us interest and we can take out this amount anytime we want to take it out. But it's not with us. It's with the bank. So last year, we had invested 100,000. This year, we have 150,000. What does that mean? It means that our fixed deposit increased. Yes, that is a good thing, but that is not our main focus. Our main focus is to know if this was an inflow or an outflow. Remember, we took the amount and we put it in the bank. So on our side as a business, this was an outflow because Satimali from Tina and we gave the bank that amount. So this one here, as much as it's a good thing that our fixed deposit has increased, it's gonna be an outflow. So in your exam, 150 minus 100,000, which is gonna give us the answer of 50,000, which will be in brackets because this is an outflow. The opposite thing is also true. If here you have 10,000, last year we had 100,000, this year we only have 10,000. It means that we took money from our fixed deposit, and it came back to us as a business. That is why we only have 10,000 left in our fixed deposits. So this was 100,000 minus 10,000, which will give us 90,000, which would have been positive because we are the ones that took money from the fixed deposit and it came back to us. That is the first one. Then when it comes to investing, we'll talk about two things: fixed deposits and fixed assets. Now remember, fixed assets, your vehicles, equipment, and land and building. There's two things that can happen with the fixed assets. We can either buy more fixed assets or we can sell our current fixed assets. Okay. Now let's say fixed asset, we have bought fixed asset. So it's fixed assets purchased. If we have bought, it's going to be in brackets. You can find the amount by either by using the 5 fingers method or they can just tell us. Then the second one, it can either be this or we can also have fixed, or we can also sell fixed assets. When we sell, we will be receiving money. We'll call that money proceeds from sale of fixed assets. Remember, this is the money that we'll be receiving, so it won't be in brackets. Now, we take sometimes you can just have this only, sometimes it's this and this, sometimes it's all of them. Doesn't matter, but your structure is like this. So when again you now say this amount plus this amount plus this amount, which would give us your investing activities here. Then we have our financing activities. Financing activities. So when we talk about financing activities, finance as a company, there's two ways to finance. We can either finance by taking out a loan, or we can just sell shares, sell or buy back shares. So it's loan and shares. So here we can say change in loan. Change in loan. Let's make an example with the loan. Let's say our loan last year was 100,000. Now this year our loan, this is loan in your exam. Now our loan this year is 500,000. Our loan has increased. Inyukile loan yethu. If our loan has increased, what does that mean? It means that we took more money. So is that an inflow or an outflow? That is an inflow. More money came to us. Yes, it is a loan, but at the end of the day, it's money that came to us. But if it says last year was 500,000, this year is 50,000, what does this mean? This means that our loan has decreased. What is the reason for the decrease? The reason why our loan has decreased is because we have paid back some of the loan. So if it's like this, decrease, yes, it's a good thing, but in terms of the cash, it's a bad thing because cash came out. So it's 100,000 minus 50, which will give us 50. That is an outflow of 50,000 because we were paying. That's still audible. Good. Then we have shares. Two things can happen to shares. We can either buy back if we buy back shares, we as a business will be spending money. So this one will always be in brackets. Or we can sell shares. When we sell shares, it's going to be proceeds because we'll be receiving money. We'll be calling that money proceeds from sale of shares. Okanye shares issued, sale of shares. So this one won't be in brackets because we'll be receiving money. The question will be telling us that how much it was, or will be required to calculate, which we'll be doing when we are doing questions. For now, is for us, in terms of now, it is to understand what is going on here before we can do the actual questions. Then again, you take this plus this plus this, get your answer. Corner la. Cash effects, there's cash effects, cash effects, cash effects, financing activities. Then again, after doing this, we now have our cash and cash equivalent. Then get cash and cash equivalent here too. I don't have space, but it's gonna be here, down here. So firstly, net change, as we were doing when we were doing. Then we have when we're doing note number 2, cash and cash equiv. I don't have space at beginning, cash and cash at end. You will do what we were doing in our note number 2. Beginning, if we were given 100,000, if the cash and cash equivalent at the beginning was 100,000, at the end it is 150,000, it means that we put on more cash in our cash and cash equivalent. The net change would be 50,000. This is just a basic example, but I did the other examples as well, so I'll be referring to those. All right, so when it comes to cash flow, this is what you need to do. Obviously, we'll be doing questions of the cash flow statement during this week. But if you understand, fully understand what I have been saying here, you are set to master your accounting. So guys, that is it from me for today. Come back tomorrow and there's something else we're doing. There's always work, man. No days off. There's always work. All right, guys, so it's me, Mr. Kumete. See you guys soon.